Hello and welcome to our educational content here on how to have a seller pay for your lower than market interest rate. You know, the market has been a little bit confusing for buyers and sellers in real estate as we've come into 2023. And so I've put together this awesome panel of professionals here in the Austin area who are going to help us have a great conversation today about how we can navigate through this market and win as both a buyer and a seller. So real quick, guys, let's go ahead and introduce ourselves. Chris, I'll kick it to you.
Hey guys, Chris Price Realty. Thanks for having us, Scottie. Really excited to be a part of this. I have been in residential real estate for 12 years, basically since out of school, have my own brokerage, and I'm excited to talk about the opportunities in the market.
Very cool. And we've got Paige with Benchmark Title. Paige, tell us a little about yourself.
Hi everyone, I'm Paige. I'm a residential escrow officer at Benchmark Title. I've been in real estate since 2016, since I moved to Austin. Love the market, love being a part of the mortgage, real estate agents, buyers, sellers. Excited to learn some more today.
Awesome. Well, we're excited to have you. And then Lindsay, tell us a little bit about you.
Hi, I'm Lindsay with Benchmark Title. I'm on the business development side, so I work with Paige and our escrow team. I've been at Benchmark for 4.5 years. Prior to that, I was in the nonprofit world, so this has been a whole new change, but it's exciting, and Austin's a good place to learn and to kind of roll with what's going on here now.
Absolutely. Awesome. And my name is Scottie, founder of Waymaker Mortgage, been involved in real estate mortgage for about 20 years, and I just absolutely adore Austin. I love the culture here in our city. I love what we get to be a part of, and I love some of the complications, which quite frankly, we're going to talk about here today. It's been a bit of a complicated real estate market, right? So, hey, this content is for you if you are a buyer considering purchasing a home in the Austin area or in the state of Texas specifically. This is for you if you're a seller, somebody who's considering selling your home and you're asking the questions, can I get out of my home what I need to during this interesting time? And if you happen to be a real estate agent or other professional, this content is for you because we want to help educate our friends and colleagues on how we can bring buyers and sellers together using the seller buy down strategy. We're going to talk today about a few different parts of this strategy. Mainly, we're talking about how to get the seller to pay for your lower interest rate as a buyer. And this benefits both the buyer and the seller. But in addition to that, we're going to be talking about what are called seller funded buy downs. And these buy downs are a win-win for the seller and the buyer. I'm going to unpack why it makes sense, how it's done. Chris is going to give us a little bit of information on the current state of our market here locally. And then we're going to do some Q&A. So sit back, relax, and enjoy. We're going to give you some helpful content information today. Basically, one of the challenges we're realizing is that it's not quite a buyer's market. It's not quite a seller's market. And Chris, I'd love it if you would tell us a little bit more about the situation we're in from that perspective right now.
Of course. Yeah, what I would tell you is the market's completely shifted. Our pandemic craziness has passed. If you look at that slide, I don't know if you can pull that one up.
Scott, working on it. Sorry. Technical issue here.
The median home price was $550,000 in the metro. And at the peak, we're now at $450,000. So really across the board, you're seeing like a 15 to 20% price correction. You kind of heard the doomsday things, like Goldman Sachs said Austin's a bust economy. I highly disagree, and I think most real estate professionals do. We just don't have that much inventory. They say a balanced market is a 6 months of inventory. You can see at the bottom right corner, we're at 2.7. So that's kind of what Scottie's saying. Like, it's not quite a seller's market. It's not quite a buyer's market anymore. We were at 0.4 months, so almost 0 months of inventory. We almost had no houses at the peak. And so what I think this shows is there's some serious opportunity for buyers. And there's sellers, right? That they need to sell their house for whatever reason. They're moving or they've had the house a long time. And so before it was, you're going to make 16 offers, to get a house potentially, or you're competing with 20 other people. It was really challenging. Now, instead of houses being on the market for 5 days, they're on the market for 50 to 60. You usually can get something a little below list. And then, the biggest concern for people is interest rates. Well, that's what we're going to talk about today, is how to get a seller to pay to lower your interest rate.
That's great, Chris. I want to ask you a couple of quick questions. As a professional real estate agent, you've been helping folks walk through both sides of the transaction. What are you seeing right now when it comes to, you have a conversation with a seller, they've just come off of 2 to 3 years of a very strong seller's market. So what are you seeing as the perception versus reality when it comes to somebody who might be considering selling their home? What should they be thinking going into it right now?
Yeah, the biggest challenge is sellers' expectations, that they had 6 months ago compared to now, right? Because it all kind of happened really fast. In about June is when everything shifted, and in March things were selling for $150,000 over list. So
this is March of 2020 versus March of 2022
versus like June of 2022.
So there's like a 2.5, 3 month period where everything kind of changed.
Everything kind of changed. When the Fed started hiking rates, all of a sudden everything kind of froze, and people didn't know what to do. And so there's always a lag effect. And I think sellers, it's been about 6 months of this, 8 months. And so I think sellers are finally wrapping their head around that it's not the same market that it used to be. So a couple of things you see, right, is most of the people that are selling now, either they own their house so long that they have enough equity that they're like, okay, whatever, I'm going to sell it for 15% less than I thought I was going to, but I'm still going to make money. There's some people that have to sell because they're relocating. There's some people that just have to sell because they need the cash. And so definitely buyers have that opportunity because usually the seller is motivated. Most of the sellers that don't have to sell have withdrawn their houses from the market. And so just because they're not moving and they don't really want to drop the price. So that's why I think it's a great time for buyers, as I think Scottie would say the same thing, and Paige and Lindsay, it's impossible to time the bottom of the market, but based on what we're seeing right now, like we're pretty close, right? It's, barring anything crazy happening like a World War III or whatever, we're pretty close to the bottom. So, what we're hearing is some point in the next 3 to 6 months, it's going to shift back, and we don't know when, but I think it's a really good opportunity right now.
Well, that's a really good point you make there, Chris. And it's a great opportunity for somebody who's been maybe not able to get into the market for the last few years. Lindsay, I just want to get your input on this real quick. As somebody who talks to real estate agents pretty regularly, what are some of the challenges you're hearing from agents in regarding being a buyer right now?
I think that they're saying their buyers, they're not getting the rates that they want.
Yeah.
If they're a first-time buyer or just someone on the lower, or on that like maybe 500 and below amount, and they need to borrow a lot of money, they're not putting down as much. They don't want to use all their cash because they're kind of afraid to spend all their money. So I don't know if you're at a higher end, you have any more cash just to burn, or be okay losing. I don't know. So they're a little bit, they can't get their buyers get comfortable putting in.
So there's a lot of fear, huh? There's a lot of misinformation. Mm-hmm. I don't even want to necessarily say that. Today, we want to try to provide information that will help people be able to make good decisions. But there's just a lot of talk out there, a lot of chatter. Like you had said, Chris, there's been some declarations about how bad the market is. Mm-hmm. The reality is, you guys on the title side, Lindsay and Paige, y'all are seeing a lot of transactions. So I just wanted to speak to this real quick before we dive into the content about interest rates and how you can get a better deal there. I just wanted to infuse a little bit of hope into the conversation. Y'all are still seeing transactions, right? Like yes. It's not like real estate is halted by any means.
No, definitely not halted. It's slowed down a little bit, but I think everyone's motivated that it's going to come back. So we're still seeing deals come in. People are people still need to buy. So it's still coming in, just not at the insane rate it was.
It was.
There's hope.
Pretty crazy for 6 months.
It was insane, but
none of us could keep up.
No,
it wasn't sustainable. Agreed. It wasn't
exactly. So I think my message on all of this for a consumer who's thinking about buying or selling is now we're normalizing. Okay, we're seeing normalization. Are we at the bottom? We don't know. Quite frankly, 6 weeks ago, earlier in 2023, I thought we were at the highest rates, and now we're coasting back down. And we've seen that roller coaster happen. And a lot of people believe that it's the Federal Reserve that's actually driving that, and that's not true. Interest rates are driven by inflation right now. And unfortunately, what we're seeing is year over year numbers are coming in, and we're seeing that inflation didn't peak. A lot of economists were saying when inflation peaks, mortgage rates will come down, because they will, and the Fed will stop hiking the the Fed funds rate, which ultimately drives more consumer rates like auto loans and things like that. But mortgage rates are reacting to inflation. So y'all need to stop buying stuff. Stop spending money.
We're contributing to the problem.
We're all locked in our house for 2 years, Scotty. We had a bunch of money to spend.
Yeah, exactly. And that's what's happened, quite frankly, guys. We've all as a society come back out into a new normal post-COVID, and now we're kind of in this together. And I really love that slogan started to become like, hey, we're all in this together during COVID, and now that we're on the other side of that, for the most part, we're seeing that okay, now we're in the changes of economy, the changes of jobs, and all that stuff together. So I'm going to dive into a little bit of content here. In regards to the seller buy down strategy. So we know that we're in a rising interest rate environment. We have been for Chris kind of benchmarked that. It was last year, primarily in about the month of May into June, rates went up pretty quickly, like overnight. And as interest rates rise, seller buy downs make a comeback. Now, the history of the seller buy down is very simple. If you were to buy a home in the 80s or 90s, okay, and that's, a lot of our parents bought their first homes during that time frame, you were paying a double-digit interest rate. So I was talking to my dad just recently about the first home that he bought and the interest rate that he had. It was like 11%. And it was, yeah, right, exactly. So it was very common back then that a seller would help the buyer to buy down the interest rate just to make it slightly more affordable so that the seller could get what they want, which is selling the home, making a certain net profit, and the buyer could get what they want, which is getting into a home for an affordable payment. Well, what started to happen really over the past year is the rates are going up pretty dramatically. Seller buy downs are making a big comeback. So we're going to talk today about what you need to know. What is a buy down? It's very simply taking money, paying it at the time of closing to lower the interest rate. That's what a buy down is, okay? Some folks know that as paying points. In the millennial and younger generation, we don't really call it points typically. That's a little bit of an older term, but if you're a boomer watching this, you know what I'm talking about. You would go to the bank and you would say, okay, I want to get a loan. Okay, what are the points? You can do two types of buy downs. Both can be seller funded. Permanent buy down, which you pay points to permanently buy down your interest rate. It stays bought down for the entire life of the loan, typically fixed for 30 years. And then there's also something called a temporary buy down, which we're going to lean into a little bit more here in a minute. Temporarily reduces the mortgage payment for the borrower. This does happen because of a seller credit. So something very important to note is a temp buy down cannot be used without seller credit funds. And the way that this works is for the first 1, 2, or 3 years of the mortgage, the seller provides a credit that effectively subsidizes the cost of that interest rate, and it lowers the monthly payment for the buyer. Any questions on that stuff, guys, before we move on?
Well, one thing I was going to ask, before we really get into it, Scotty, is so I think a big challenge too for buyers right now is we were so spoiled with 3% interest rates, right? That historically in the history of America never happened. And so what as a lender would you tell, how have you been able to get people more comfortable with that? That's a challenge I have too, right? Is like you said, our parents, an 8% interest rate was a steal, and we're at a 6, 7, and people think it's horrible because we were at 3 for 2 years. So just wanted to get your thoughts on.
A lot of times, and I'm doing this like literally raw and real right now. I'm going to share my my web browser window, and I'm just going to kind of show you guys what I would like quite literally show a client. So here we are, Google historical mortgage interest rate chart. Okay, I go to Freddie Mac, or we'll go here. We'll go to Freddie Mac. Let's just look what it says. So current mortgage rates since 1971. It pulls up this chart. Anybody can open this thing. And it'll actually show you what the historical interest rates have been over time for, years and years and years. And it looks like that my screen share is not working to open that up. So I apologize. Let's do all on this chart. So this is going from April 2nd, 1971 to today as we're recording this, March 2nd, 2023. Okay. Can you guys see this chart? Is it working okay?
I see it.
So here's what's interesting. We're going all the way back to 1971. We see this data where we started somewhere in the 7s, 7, 7, 7, 7s, 8s, 9s, all the way up here into this,
That's insane, 17%.
You guys see this?
That's probably where my parents were.
Okay, so this is 1982, 17.56%. And this is just a reality check that every buyer needs to have. Okay. And you can sit there and play around with this. I was trying to prove a point here. You can sit there and play around with this yourself. If you're in this position as a buyer, here's where we got real lucky, guys. 2s, right?
Yeah.
2.73, 15-year, the 2.19 mark. Hey, I got a mortgage in the 2s. You know what? I do mortgages professionally. I wasn't going to miss that boat. But the truth is, as a buyer, if you did miss the boat, that boat's not coming back most likely. And if it does, it might be a really long time. So here's what's starting to happen. We're normalizing. So if you look at this trend, okay, if you look at this line right here, gosh, we are below average market interest rates, even now still in the average of, that was at November 10th, 2022 at 7.08%. We are still below historical average. So that's what I would tell a buyer is, yeah, I'm sorry you missed that boat. I feel for you. I do. But at the end of that, here's what the data says. You're still able to get a historically low rate, you know, and you can look at the 10-year. I mean, yeah, obviously, if you would have bought 10 years ago, you know, we've been really, really lucky or blessed, however you want to put it, in the last 10 years to have great interest rates in this country. Right. But again, if you go back historically, it's not bad. Okay. So here's what I advise people on a very regular basis. You've just got to buy a home that fits your lifestyle with the affordability of the monthly payment. Yep. That's the bottom line. And hopefully, what's that?
I'm sorry. Hopefully, like you said, get the seller buy down or hopefully refinance.
Yeah, right, absolutely. And so there's a couple paths forward. You know, if none of this we're talking about today works for you, and you just have to buy a home, and you've got to take the interest rate that's available on the market in order to get what you want, well, refinances will come back, and we will see rates probably in the 4s and 5s because that is our more sustainable historical average over the last 10 to 15 years. And so I'm not saying I got a crystal ball, and I'm darn sure not telling you when. It is not a commitment to lend, and this is not a commitment to an interest rate. This is just Scottie's personal opinion that at some point in the next 12 to 24 months, we'll see rates in the 4s or 5s. So if you buy in 2023 at a 6, 7, or God forbid, 8% rate, you're going to be able to refinance out of that. Okay. And we could talk more about that all day long. So back to what's the difference here? So how does a permanent buy down work? So a permanent buy down uses a seller credit that's applied towards the discount points that permanently reduces the interest rate. Okay. So here's a really simple chart. Let's say let's say your rate today is 7%. And that is a no points rate, meaning you don't pay anything for it and you don't get any credit for it from the lender. So at 7%, no cost. You want to be at 6.5% in order to get to the payment that you're looking for. Well, the cost of that is 3% of your loan amount up front. So, if you were to finance $225,000 loan amount, that cost to the seller would be $6,750. Does this make sense?
Yes.
Important thing to note, you've got to check with your lender because the seller credit cannot exceed the maximum seller contributions for the selected loan program. And that just simply means that every loan program has a limitation for how much the seller can invest towards the buyer's costs. And we're not going to get into all those details. Talk with a qualified lender. Call my office. We'll help you we'll help you get the info you need. But permanent buy down, that's how it works. Now, temporary buy down. This one confuses people, quite frankly, because the permanent, it's a little more easy to understand. The temporary buy down, seller credit is put into an escrow account to supplement the borrower's monthly payments for the term of the buy down. Now, here's a few things I'm going to go through before even reading through the slide. First and foremost, one of the reasons I love this type of buy down is because if you do this temporary buy down, let's say you do a 3-year buy down and year number 2, you refinance that mortgage loan. Well, the money that's sitting in that escrow to subsidize the cost, it gets taken off the principal you owe. So you don't lose that money. Versus if you do a permanent buy down, that money's paid up front at closing, is gone. It's not coming back. Totally cool if you refinance or sell the home, but you're not getting your investment back. Does that make sense?
Mm-hmm.
Yeah, that's good. That's good info.
So yeah, that's why the temp buy downs are a little bit more attractive right now. And by the way, these can apply to any mortgage type. So conventional, jumbo, FHA, VA. I mean, we're doing high balance VA loans, in the $1 million, $2 million range, and we're doing seller buy downs. And it's a great loan for a veteran to acquire a high dollar property.
And so are you seeing more of the temporary or more of the permanent?
I'm seeing a lot more of the temporary than the permanent right now. we're using the temporary more for the first-time home buyer who is trying to qualify for more mortgage, and we have to permanently buy down the rate for qualification.
Got it.
So, for example, without buying down the rate, they may only qualify for $300,000. With the rate buy down, we can get them to $400,000. So we're doing that permanent in order to get them more house.
Okay.
The temporary is more about the comfortability of the monthly payment. You can afford the full payment, you can qualify for it, but this is about comfortability and benefit. Any questions on that?
And I think one good thing would be, right, the temp buy down costs the seller less, correct?
Generally speaking, yeah. Actually, let's go through this example because we could touch on that. So let's say our interest rate, just like the other examples, at 7%, loan amount $225. We got our normal 30-year fixed principal and interest payment at $1,496.93, so just under $1,500 a month. When the seller credits the buyer with the buy down subsidy, this amount is applied to the monthly payment in years 1, 2, or 3, and it reduces the buyer's payment for those years. So this strategy helps a home buyer ease into the home, lowers their payment for a period of time, and it frees up funds that otherwise would have gone to other things. So it's basically, in a way, it's like, think of it this way. It's like the seller gave the buyer some money, and that money's sitting in a savings account, and they're using that money to help pay their mortgage payment every month for 1, 2, or 3 years.
It's great.
Easiest way I can explain it.
Yeah.
Because it goes into an account. Now, the mortgage lender handles all of this. You don't have to think about it as a buyer. You definitely don't have to think about it as a seller, other than making the decision to say, yeah, I'm willing to do that. And this is great because for a seller, it's painful to reduce the price of your home, right, Chris? Like, sellers don't want to do that. It's painful. It's not
tough.
fun.
Feels better to do this, yeah.
It feels better. Conceptually, it feels better to say, I'll give you $10,000 or $15,000 or $20,000 or whatever it is. And for the buyer, we have to work them through the process of, they think, typically, most buyers think, okay, I want money off the home. And we have to say, let's rewire that, because it's actually going to save you more money over time if we can get you seller funds. So it moves the needle faster to move the interest rate down than it does to take $10,000 or $15,000 off the price of the home. And, we can show other examples of that. But okay, so here's temporary buy down math. And this is what I really want to lean into. So we're assuming a $225,000 loan amount, 30-year fixed rate loan. First year, your note rate, stays at 7 because it's a 30-year fixed, 7% rate. Your buy down rate for year 1 is effectively 5%, which lowers your monthly payment by $289.08. So you're saving $290 a month. Second year, effective buy down rate, 6%, reduces your payment by $147, $148. And then years 3 through 30, you're up at your actual full-on payment of roughly $1,500 a month. Okay? This is called a 2-1 buy down because it is effective for 2 years and it moves the needle 1% each year. Okay, what questions are popping up in your mind when you're looking at this?
I would say one is, how much is that going to cost the seller?
Yeah.
Okay. Yep. So we're gonna let me see if that, where is that calculation? Give me one quick second here. I think no, that's the wrong page. Sorry guys. I had that calculation. It seems to have escaped. Let me run that real quick. I'll put it let me run that on another screen here. Give me a second. But what other questions do you have while I'm doing this? Because I want to give you that full calculation from the seller's perspective.
I mean, is it hard to convince the sellers to do this? I guess, Chris,
that's a great question. Yeah, Chris.
Because, it seems like you're saying it's a way of thinking, like, take $10,000 off your sales price or pay $10,000 to my buyer. I mean, what's the motivation?
It's a good
one
question.
versus the other.
I think once you explain it to them, if it's the same amount of money, I don't think they really care, right? Whether it's $10,000 down on the price or $10,000 towards a temp buy down or seller, an interest buy down. I think what I'm seeing at this point is they're getting offered up front a lot because houses are moving. They're taking, like I said, 50, 60, 90 days. And so all of a sudden their house is on the market for 45 days. They drop the price, still not getting traction. And then they come they come out and say, hey, we'll offer a seller buy down.
Yeah.
And so it's becoming more and more common for the sellers.
So what happens to drive that conversation, Chris? What's the how do you create that conversation with them?
I mean, the thing is like when you have a listing and it's not moving, right? You got to be proactive, especially as an agent, right? Because the whole goal is to sell the house. Your clients, they usually have a bottom line, and that, but you also want to maximize the return. So, if I'm not getting activity for 30 days, we're talking about a price reduction for sure.
Oh, wow.
Conversation, and if they say, hey, we want to wait 30 more days, it's, it depends case by case, depends on comps, but we're going another 45 days and still nothing, that conversation's coming in.
Oh, sorry.
Go ahead.
Scottie, does this have to be determined before there's even a contract or?
Great question, Paige.
Yeah.
So no, it doesn't have to be determined. In fact, I'm actually live negotiation with one right now where we got a deal under contract. Okay. Mm-hmm. No seller concession, no seller contribution. But now they're talking about it with the inspection and all that type of thing. They're actually talking about, hey, instead of us trying to nickel and dime you and, whatever, go into all that on the inspections, what if we do this set amount of money and then on the backside, we're going to apply those funds to buying down the buyer's interest rate?
Because that's what I see on our end more. People don't want to reduce the sales price, and so we'll get amendments for seller credits, and we don't always know why, but I'm assuming it's
and quite frankly, in the mortgage world, we don't want to show an underwriter that there's a problem with the roof and there's a problem in the attic and there's issues here and there's issues. We would rather just see a nice clean amendment that says seller's giving buyer $10,000 to use towards their costs.
Don't ask questions.
Don't ask
that money. So to answer your first question on the cost, this is a buy down calculator that I've put together. It's very simple to use. But so we're using our purchase price here of $250,000. Actually, I think in our model, were we doing 250 or 225? Well, I'll show you how to calculate it. Was it 225, Chris?
Loan amount was 225, so I think you're good.
Yeah, so loan amount 225, there we go. And yes, that puts our monthly payment at a 7% rate at $1,496.93. So that's our example we've been using during our slides. So here are the year one and year two for the 2-1 buy down, and here's the cost to the seller. So it's $5,244.29, which is a 2.098% concession. So in reality, for a buyer, where it moves the needle, first saving them, $34.68 first year, $17.75 second year, a total of $52.44. That's where I'm using my analogy of a savings account. I mean, this is a big deal for a family.
Yeah.
This is a big deal for affordability. And, like you were saying, Chris, it can help the seller to kind of have that reality check to say, okay, I want to move my house and I don't really want to drop the price again. Here's something I'm seeing is sellers may not be willing to have the conversation until they get exposure to the market.
Yeah, agreed. And the cool thing about this, like you're saying, is that's a lot of money, when you're, you go from $1,500 a month almost to $1,200. And then, like what I'm having a lot of people that are struggling right now purchasing, if they're purchasing in the 800 to $1 million range, from a 3 to a 7, that's like $2,000 more dollars.
Absolutely. Yeah. I mean, and
that's a big jump
difference. Yeah.
We can do a live calculation here. Give me an example of a higher to a long one.
Let's go $800,000 loan, $1 million purchase price.
Nope, I missed a zero. And let's say our rate, jumbo rates, let's say our rate's 7.5.
Yep.
All right. So we're going to do a seller funded buy down on $1 million purchase price. Look at that. It's only costing just under 2%.
Yep.
Which, when you're talking about $1 million home, $20,000.
Yeah.
It's a lot. Look at that. I mean, $1,000 less a month.
This is a huge deal for the buyer. It's a big deal for the seller because it helps them to conceptualize, I can help this buyer. I can get what I want by helping them get what they want. Yeah, and I think, that goes back to you guys probably heard the old Zig Ziglar saying, you help enough people get what they want in life, you're going to get what you want.
Yep.
And I think that's a mentality. If I'm selling my home right now, I've got to be open to this. I've got to be open to not saying, I am the seller of this house who's going to get exactly what I want for it. And you've got to be more so open to saying, okay, what's the market reading? And what am I willing to do to help the next family enjoy this home that I have?
Yep.
And if you're an investor, you're probably looking more at the bottom line, but you still got to be willing to say, okay, I'm going to trust you, listing agent, to negotiate this on my behalf, because $800,000 loan, that's a huge amount of savings for someone.
A lot.
A couple of years. I mean, I don't know about you guys, but every $4,000 or $5,000 a year counts, let alone every 12 or
That's like the monthly cost of a brand new Tesla. I don't have $1,000 a month. That's a lot of money.
That's the truth. Yeah. And, again, this is what I communicate to every single buyer I talk to about this program. You've got to be comfortable with this monthly payment at some point. Yeah. You have to be willing to say, I can afford this by year 3. And on paper, you have to qualify for it, of course.
Right.
But
it's like, I like that, because it's like you're being cautiously optimistic, right? Like, I think rates are going to come down, right, in 2 years, and hopefully I can refinance. But if not, worst case scenario, I can pay this $50.
I can still afford it.
We're doing what we can to make room for the future while looking at today and saying, okay, this is how we get business done today. This is how I get the house I want today. So yeah, just to kind of pop through the few remaining slides here. Benefits, right? How does this help the seller and the buyer? So let's look at the seller side. Seller credits help a home sell faster in a buyer's market. Well, we know from what Chris told us, we're not quite in a buyer's market, but we're kind of in that middle ground. It's almost like a no man's land purgatory kind of feel right now. So some deals are going to be a buyer's market and some deals are going to be a seller's market. Price reductions are costlier to a seller than credits. And it's an innovative goodwill. And this is kind of what I was talking about a minute ago. It helps the homeowner adjust to home ownership. So it's goodwill. It's me as a seller saying, if you're willing to do that on the front end and put that in the MLS as a comment and say, I'm willing to give X amount of dollars towards the buyer's interest rate buy down, provide special financing, that's a marketing technique that's going to bring more people to look at your home. Right, Chris? I mean,
yeah, I agree. And I think it, the biggest thing I would try to say to sellers, if any that are listening, is those days of saying no to everything are over. If you want to sell your house right now and you need to sell it, you're going to have to get creative. You're going to have to collaborate. You are not like Scottie, so you can't be the no person anymore. You got to be the yes.
Yeah, we've been seeing a lot more seller credits and any kind of credits that the sellers give the buyers a lot more recently than last year.
Yeah, it's an old school new way to do business, right? It's the way we saw it a lot a few years ago.
Yeah,
and it's been foreign since 2020 in many regards.
Yeah,
I know we're talking about doing business around the city of Austin. VA loans were almost unheard of the last couple of years in the city of Austin because they were just tough to get sellers to accept. And now we're seeing more of those on our side too, which is cool. I love helping veterans to buy homes, and I know you guys do too. So it's so buyer benefits. We allow the buyer to ease into the home ownership by paying below actual fixed payments. Does not increase the loan amount, and the loan amount amortizes as a normal fixed loan. So it's really important to note, as a buyer, this is not an adjustable rate mortgage. There's no cloak and mirror, or what's the word I'm looking for? There's no
cloak and dagger.
Cloak and dagger. Thank you.
Oh, I don't know that.
Smoke and mirrors.
Yeah. You're not coming back to the lender or the realtor going, "What did you do?"
Yeah.
This is all upfront and transparent. It's a 30-year fixed rate loan. It's a great loan. Can be applied to all the different types of loans that we look at in today's market. And it's a safe way to take advantage of a lower payment in a rising rate environment. Why do I say it's a safe way? Well, another pitch that lenders are making right now is adjustable rate mortgages. And, I've been in real estate for almost 20 years. I've had adjustable rate mortgages. I don't have a problem with them as long as you understand it and you use it in the right capacity. But many families, especially folks who have had any exposure to the 2007 through 9 period of time and the crash, adjustable rate mortgage is a curse word, and they're like, never, never, never. So, this is a way to avoid the arm, getting a fixed rate in a safe way. For time, I'm going to skip over that one.
Yep.
I'm going to make sure I reiterate this. What type of loans allow seller-funded buy-downs? Conventional, Fannie Mae and Freddie Mac, FHA, VA, USDA, and what I call special use case loans. So that's investor cash flow or DSCR, bank statement, any kind of creative loan out there that's used for residential purpose. Like 98% 8% of residential loans have a temporary buy down allotment. And if they don't have a temporary buy down, you can still do the permanent buy down in every type of residential mortgage loan. So that's great. Which program is better? Well, that's why you have the Waymaker team. Right? So if you're trying to weigh the benefit of permanent versus temporary, let's talk about it. Let's have a conversation. Chris and I would love to help you put a plan together. The ladies here at Benchmark are going to help you through the transaction piece, and we're going to get you ready for that. We review the numbers with your seller, so that's an important point. Like, you don't have to know this, you don't have to negotiate it. Chris is going to represent you well, and the real estate agent on the other side, we're going to work with them and help them to present this to their seller. I will get on the phone with the seller anytime and explain this. I love that. I think it's actually really fun to be helping a buyer and seller come together. We let the real estate agents do their job as mortgage lenders. We're just saying, here's the numbers. Here's why we think it makes sense. You guys go make that decision. I tell every one of our buyers, you need to have the right information to make the right decisions. And that's the case for sellers too. Helps, want to help the buyer consider their options, and then to help both the buyer and seller choose the program that's right fit for them. At the end of the day, it comes back to that data-driven decisions piece.
And I think that to add to that, of the last one is, I think that's good if the buyer and seller, like we're talking about, can collaborate, right? Because like you said, there's all different buy downs. There's the permanent, the 2-1, 3-2-1. I recommend sellers buyers to be flexible, right? Because, maybe a 2-1's better for one of them and a 3-2-1's better for the other. Let's try to figure something out that works for everyone. You may not get everything you want. Same going back to the buyer, sellers need to say yes more. The buyers can't just come in and
it's for everything.
For the seller, we're not right work either. So,
there's 1-1 buy downs now too. I don't even have a calculator for it because they're so new, but we can do 1-1 buy downs. We funded one of those last month where the first year is subsidized, simply put. And I think those came to be because we were seeing small seller credits, so we're like, okay, let's use that money in the way that it moves the needle the most.
That's helpful.
That pretty much wraps up our content today, guys. I wanted to just kind of kick into a little bit of a Q&A session just for a couple of minutes. Paige, you see a ton of transactions, and it sounds like you see cash transactions and mortgage transactions and everywhere in between. What would you advise a buyer in today's market with it, knowing this information now?
I definitely think just educate yourself with the appropriate real estate professionals. That makes it easier for everyone, sellers, buyers, us. Just knowing the market with your real estate agent, knowing what you can get with your lender, and getting the best house you can for your needs. Yeah,
that's awesome. That's great advice. Got to educate.
Yeah, and then more education. I mean, it makes the whole transaction easier. You're not lost the whole time. You're not confused why you have to pay this or so.
Ask questions. People can help you along the way, but it helps if you know a little bit of the background.
Yeah.
Well, Lindsay, I want to ask you something. If you're talking to a buyer, so a friend of yours says, "Hey, I want to buy a house this year in 2023." What do they do? Where do they start?
Call Chris Price Realty.
Yeah, Chris and my friend Scottie. I guess that my friends are kind of moving into their we're forever home at this age of their kids. So I mean, they've kind of already bought a house. But for new people that I meet with, like new home buyers and people, I say start with the mortgage for sure. See what you can qualify for. Don't be scared of it, because there's so much stuff I don't even know about at this age. There's so many things out there. So just ask, meet with your lender first. Because if you meet with the Chris first, you're going to find a house you love that you can't afford maybe, but start with what you can afford and what you know.
Well, and Chris will lead you with your expectations on.
Exactly.
Yeah. I couldn't agree more. I think that's so much better, and you do run into that. And sometimes people are real, it's like whether maybe they don't want to get their credit pulled or just kind of nervous. Yeah. You have had a bad experience with the lender, but you got to do it. You got to get pre-approved.
People are scared of pulling their credit. I do need some, that always comes up too. So I try to say, that's not going to hurt you, but maybe there's a better example. I mean, how many times you can...
I probably answer this question 450 times a month. I don't know. But so here's the simple answer that I've come up with. I say a mortgage lender needs to review your credit. I don't use the word pull because it just has a negative connotation. So we say a mortgage lender needs to review your credit in order to figure out what you qualify for. It's not going to lower your score to have your credit looked at for a mortgage, but it is going to give you a competitive advantage so that you can get out there and actually look at the homes that are available to you. So I always just use it. Hey, they're going to have to review your credit. Like you can't get around it. Yeah. So just accept that fact. But, I'll also tell people that one of the most important factors of credit is credit card utilization and monthly payments and stuff like that. So, as I'm kind of pre-qualifying them through a conversation, and I tell our realtors this all the time, get them to talk about it just a little bit, enough to say, man, you got to talk to my lender, and hopefully you're saying Scottie Campbell, but you got to talk to my lender, Scottie, because he's going to help you to know how to navigate all that. And he's going to be able to provide you with the right information to make the right decisions. So we come off of the objection and we bring into the reality of you can't get around it. If you want to buy a home,
you have to do it.
Part of it, it's part of it. And I love what you said, Chris, or I think you said it, Lindsay, actually, about expectations, right? Somebody said expectation, maybe, I don't know.
Lindsay, yeah.
I'm going to talk about expectations. So we got to set expectations. A great realtor is going to have a good conversation with you on the front end. That's what Chris will do. Introduce you to a mortgage lender. We're going to give you a clear mortgage plan, and then you're going to be able to have a strategy. Hope is not a strategy. I would like to buy a house in 2023. Whether it's a first-time buyer, a move up, a move down, doesn't matter. I mean, we talk to folks who are buying their fifth and sixth home, and they're still in that, like, yeah, when we're ready. They're kind of self-qualifying. I'm like, hope's not a strategy. How do you know when you're ready?
Yeah.
Ready when you have a plan. You got to have a plan. And so
I always ask to get a plan made.
Exactly. You have to work with a strategic lender that's going to walk you through the process. You have to work with a local expert realtor. And then you want a great escrow team in your back pocket. I can tell you a horror story. Last year, I bought a house. My wife and I purchased a home. The title company is now closed. The seller chose the escrow team. And I'll be honest with you, it was horrible. It was a horrible experience.
Yeah.
And that's something that, having a great real estate agent, a great lender in your corner is going to protect you. Again, is we know who you want to work with. And of course it's benchmark, but, we know, the good and the bad.
Right. We've seen it all. We've all seen it all.
Okay. And that's like, that would, so when folks come to us and they're like, well, I kind of self-diagnosed and, they want to tell their whole story and everything they Googled. And I'm like, hey, listen, I appreciate all of that. But quite frankly, this is kind of like you going to the doctor and telling them what's wrong with you.
Yeah.
We're here to give you a clear plan. And this is what we do all day, every day. So we're here to help you walk through that process. And I think that's the most important thing is don't be afraid. Don't be afraid. There's no fear when it comes to getting ready to buy, whether you're whatever price point you're buying at. I talk to folks buying multi-million-dollar homes, and they have the same fears that folks buying a $300,000 or $150,000 home have.
And say with us closing a $100,000 deal or a $2 million deal, it's the same process.
It is.
So
I love everything we talked about today, guys, and I want to keep this. I think we've covered a lot of content. I want to kind of bring this to a close. Are there any questions that are coming up for you guys that you feel like we need to answer before we wrap it up?
I think that was good. I think just add to what you were saying, Scottie, is fear. Fear, that's everything in life, right? Don't let fear prevent you from making a decision right now. And everyone's scared right now. This is the time when smart investors make good decisions because everyone's on the sidelines afraid. And it's okay. Hey, even if you are afraid, it's okay to feel it, but don't stop yourself just because you feel afraid. That doesn't mean that it's not time to do something. It actually, in our opinion, now is the time.
Yeah.
Feel the fear and do it anyway. It's what one of my business coaches says. Feel the fear and do it anyway. Just make sure that you're willing to take some steps of action. First step is a conversation. Have a conversation. So reach out to any of us. If you have any questions, we're here to help and serve. This concludes our content for today. Really, really thankful for you watching it. If this is meaningful to you, please get the word out there to somebody else that you know as well. I always like to say, share this with 3 people you think it would benefit, and then reach our way, and we mean it. We are real people willing to help folks just like you to succeed with your American dream. So thank you for being here. Team, thank you guys so much for your input. This is awesome. Have a wonderful day.
Thanks, Scottie. Thanks, Chris.
Bye. Thanks, guys. Bye.